For decades, portfolio construction has felt relatively straightforward. Stocks were meant to provide growth, and bonds were meant to provide stability. And diversification largely meant balancing the two. But over the past several years, markets have challenged those assumptions. We've experienced inflation shocks, rapidly changing interest rates, concentration in mega caps, and a market environment where traditional diversification hasn't always worked the way investors expect. At the same time, the pace of change in markets has accelerated. Leaderships rotate faster, correlations shift faster, and narratives move faster. All of this raises an important question. What should portfolio construction look like today? And luckily, we have the perfect guest to talk about multi-strategy investing. I'm joined once again by Pender CIO and portfolio manager Greg Taylor to discuss the Pender Alternative Multi-Strat Income Fund, as well as the newly launched Pender Alternative Multi-Strat Growth Fund. How these portfolios are built, what problems they're designed to solve, and why investors may need to get a different framework for diversification going forward.
This podcast is for information purposes only. It should not be viewed as investment advice or as an offer to buy or sell Pender's funds. Our funds are not guaranteed, and any discussion of past performance is not an indicator of future results. Any opinions expressed are as of the date of this podcast and are subject to change. Pender may not necessarily share the opinions of our podcast guests. More important information can be found on our website, penderfund.com/disclaimer.
Greg, welcome back to the podcast.
Sure. Thanks for having me, Laura. Always back to the talk.
Great. So how about we get started at a higher level since you're a returning guest? Do you think the definition of a balanced portfolio has changed fundamentally over the last several years?
Oh, absolutely. I think that's one of the biggest changes we've had in portfolio management theory in decades, because I think people just frankly got lazy. There was a whole mantra and the whole industry was stuck with almost a 60-40 portfolio. So the 60-40 portfolio was basically what everyone had. And as you mentioned in the lead off, that the equities were supposed to be the growth and the fixed income were the income side. I mean, we've almost had a paradigm shift in the last little bit where that doesn't really work as much as it has. And sometimes we've actually had the opposite where the fixed income's been the growth and the equities have been the income components. And these kind of set in stone beliefs have started to be really questioned the last little bit. And of course, the biggest thing that's happened in the last years are that we've started to see a fairly high correlation between these two asset classes. So having just equities and fixed income isn't really giving you the diversification you wanted. And really where this became apparent was in the early parts after COVID in 2020, when basically we had correlations go to one, as we've had most of the equities were long duration tech assets, and most people held in their fixed income allocation long duration bonds. So you've got basically doubling up in the same trade. And then when yields go the wrong way, that can hurt. And I think that's really was the wake up call for a lot of allocators, and people are still trying to get used to this concept because we've got a lot of volatility. We've had a lot of change in assumptions in fixed income markets and where yields are going. And this is really what people need to look at when they're looking at their portfolio these days.
Yeah, it's interesting because, I mean, if you think about like what we learned in our finance textbook, you always heard portfolio management meant diversification, and that you could kind of diversify away a lot of that beta risk by owning kind of more positions. But in environments like today, does just owning more stocks or more bond really mean that you're diversified in today's markets?
Well, and that's a good point. And because really the whole questions about diversification are being thrown out there right now, because even when you look at the index, and I think right now, we've talked about this in some other conversations, that the passive index is becoming really risky right now. And right now, concentration in the S&P 500 is back to where it was in the dot-com days. So the top 10 names are getting close to 45% of the index right now. So just buying an index fund isn't really giving you that diversification you want, because you're really buying into one theme, which is really focused on AI and technology. So you're really not getting that diversification you think you are. And then when you add onto that long duration bonds, you're again doubling up on this. So this is where I think you're getting the rise of liquid alternatives, more hedge strategies, long short things, because you're really trying to find something that's not correlated with the other asset class. And that's really what you want when you want diversification. And you're not getting that from traditional sources these days.
Yeah. So I guess it sounds like today diversification, it's more about diversifying those return drivers rather than just having more holdings specifically. Is that how you think about it?
Yeah, because right now, like that's the thing. More is not always better, and you really want to figure out when you're putting in your portfolio and making allocations to different asset classes and different buckets. You want to really make sure that those buckets are as uncorrelated as possible, because if you're just buying more of the same thing that are all correlated together, that doesn't help you at all if you get one of these shocks that hit the market. So it's all about trying to find within the buckets in your portfolio something that's uncorrelated and will work as a diversifier, because what you want to do ideally is to smooth out the bumps along the road. I think everyone's got an objective of where they want to get to, but if everything's correlated, that could be a fairly wild ride. And that's where you're trying to find things that are less correlated and more diverse, and that's going to start to smooth things out to have a much more enjoyable ride to the end.
Yeah, no, I like that idea of kind of smoothing out the ride. When you do see these narratives impact markets so dramatically, how important has flexibility become with the way you manage a portfolio and having a little bit of a less rigid mandate?
Yeah, and that'll depend on the mandate, and every mandate is written differently. But you want to have probably a little more flexibility than normal, because there's going to be different opportunities you want to take advantage of. There's going to be times when things get extremely overbought or oversold, and you want to make sure you can lean into those to try and take advantage of this, because it's becoming harder and harder to make money in the last few years. So trying to find ways to do this, you want to have some flexibility in this, but of course, you're not going to go all in one strategy versus others, and that's where having multiple levers you can pull, different strategies which will work complementary or negatively correlate with each other. These are all options you want to have on the table, so it can really have the best outcome from your portfolio.
I guess what you're saying is, with this increased flexibility, that's where the importance of mandates like multi-strategy investing become more and more important. The thing is, sometimes when you hear a term like that, multi-strategy, it can mean a few different things. Like, from Pender's perspective, how would you describe multi-strategy investing?
Well, I think you're right. There's a lot of different definitions about this, and what it really comes down to is you want to combine distinct uncorrelated investment strategies into a single portfolio, really with the goal of trying to generate consistent absolute return. And I think that's really what you're looking at, because it's trying to get, again, you want to have these different strategies which aren't going to trade exactly the same, and they're going to be more of a complement. And at the end of the day, this is going to be something that's going to be smoother over time, and hopefully generate a much less volatile return stream.
What would you say, I guess, is the main problem that a multi-strategy portfolio is actually trying to solve? Is it that volatility? Is it diversification, smoother compounding? How do you think about?
I think it comes down to consistency more than anything else, because you want to really get away from some of the big swings. So a less volatile, more consistent return stream is really the end goal for multi-strategy funds. And you can have this in fixed income or in equities or other asset classes, but it's really, again, to try and smooth out the ride and get rid of some of the volatility and the noise in the portfolio. And you really want to do that through uncorrelated asset classes. So combining more strategies which aren't going to act exactly the same as the other ones into one single strategy should start to dampen the volatility and provide a much more steady stream of returns.
Yeah, so would that mean better downside resilience as well when we're seeing these swings to the up and down?
Oh, absolutely. And again, the goal in these strategies can be different. We've got the multi-strat income fund, which is the goal of a steady stream of income. Then we've got the multi-strat growth fund, which is really an absolute growth fund. But consistently across both of those strategies, it's really dampen the volatility, try and protect on the downside, and try and generate that outcome you're trying to get to, but with less volatility and really a much smoother ride at the end of the day.
Yeah. Maybe going into those funds specifically, we did recently relaunch the multi-strategy growth fund. So how are you looking at that fund today? Like, why relaunch it now with kind of a more specific mandate, and what opportunities do you see from that growth side?
Yeah, and this is going to be early days in the strategy, and it is going to evolve over time as the fund grows and gets bigger. But right now, it's really focused on two strategies. And that's going to be something which, again, we think is more a complement strategy and not going to exactly the same thing from an overlap. So The core of the fund is going to be a combination of the Dayfire Small Cap Opportunities Fund, which has been up and running 15 years plus, and then my Purpose Alternative Select Equity Fund, which I've been running since 2006. And both of these strategies together work really interesting together because when you look at it, it does start to dampen the volatility. There's a little more volatility in small caps from the Small Cap Opportunities Fund, and there's better downside protection in the Select Equity Fund. But when you put these together, you've got a nice stable return stream. They're still going to give a nice absolute return number, but dampen the volatility, have a little more downside capture in this. And then what we're doing right now is complementing that with our Plus Fund, which is going to be more of a core to the portfolio, around 20%, that's going to generate some more stable returns that's going to, again, dampen out the volatility and provide a more steady return stream. While the special opportunities and the Select Equity Fund can be a little more volatile. But together, they're going to start to smooth that out and have some sort of negative correlation because they're going into different parts of the market than each other strategy would.
Yeah, no, that's really interesting. So I guess the way you act as the manager is you would adjust the different weightings for each of those funds depending on how you would look at markets. Is that how you think about it?
Yeah, we're looking at both of those strategies really within bands, and strategies will evolve over time. And as the fund grows, we can add different strategies to the mix as Pender grows and new funds come online. But really within that, from a tactical top-down point of view, we can tilt depending on our view of the market. If we're super bullish on small cap, we can make the Small Cap Opportunities Fund not the majority of the fund, but the top weight in the fund. If we're getting a little more cautious and thinking there's volatility, we tilt more towards some of the more defensive strategies, ones that have some more hedging, can have some downside protection, like Select or like the R Plus Fund, which are going to be less correlated to the market and more of a stable and a buffer in times of volatility. So we do have bands for each of these allocations, and we can tactically move that to try and, again, limit some of the downside and to try and take out some of the day-to-day volatility in these strategies overall.
Yeah, and I guess it comes in a simpler package than an individual investor having to kind of make those allocation decisions themselves on a consistent basis. This is something that you are monitoring consistently.
Yeah, something that we're constantly as the Pender investment team looking at the different allocations. All of these strategies are actively managed. So none of this is passive as well. So we've got bottoms up PMs looking at these strategies, actively managing and tilting where they think they should. And then from a top down point of view, we're looking at allocating within these bands to tilt towards where we see the best opportunity and where we think there's opportunity to both limit downside and also provide some upside and absolute return.
Yeah. So from an investment perspective, what role would you say the growth fund specifically is designed to play in a portfolio?
Well, it's a complement to your core. I think most Canadians and most investors have a lot of the core pretty much figured out already. That's the big banks and then the telcos and such. And we're not really going to double up on that. Both of these strategies are really going to different parts of the market that are not your core, but able to have better risk reward metrics, in my opinion, because there's a lot of people just don't go to these areas because they're more volatile and harder to look at. So Small Cap Opportunities looks at small cap Canada, more focused on technology and consumer. Select Equity can go anywhere as a thematic based within North America. Right now, it's got a little more of a bias towards materials and resource stocks. But when you put all that together and complement that with a core portfolio, it really helps return your Sharpe ratio because ideally you'll get still a better absolute return, but also less downside. So it can help in terms of volatility, which I think we're all recognizing we're due for some volatility. There's been a lot of volatility in the bond market, but equities have been looking over the valley and seeing through this, but this at some point is going to catch up to us, and this strategy is designed to have that absolute return goal, but also to make sure that there's some downside protection embedded in the strategy and act as a complement to the core.
Yeah, I think you make a good point too, is people always think about the US and the S&P 500 being the Mag 7, and it's super concentrated, especially now. But when you look at Canada, we've always had a very similar concentration risk. Like I've heard the term of we're like the land of oligopolies, so between those telcos and the banks, and even and the rails, grocers. That's a pretty significant percentage of the index. And so being able for an investor to own something is as easy as owning an index, but maybe offers a lot more exposure to names that you wouldn't necessarily look at a consistent basis is quite interesting.
Yeah, and you're right. I think every Canadian owns a little too many banks, and that's been okay. The banks have had very good last 18 months. I think, much to most people's surprise, as there hasn't been a lot of growth in the Canadian economy, and usually the banks are acting like the Canadian economy, but many of them were up 20% plus last year, and off to a good start this year again. But that doesn't always just keep going, and there's going to be volatility, and having something that can be a complement to that is really what this fund is designed to do.
Yeah, like you said, smooth out the bumps in the road.
Yeah.
So maybe let's contrast growth with a little bit longer tenured multi-strat income fund. So how do those philosophies differ specifically?
Yes, yeah. So the multi-strat income fund is really, as the name defines, the goal is to generate income. And this is a fund that's really going to be a nice complement to traditional income strategies, as it's going to have some great income components paid on a monthly basis. But again, we're trying to smooth out the volatility. And this is one where what's been fortunate for us is within Pender's lineup, we've got two really great credit strategies that are negatively correlated. So when you look at this, we've got the corporate bond fund run by Jeff Castle for the last 10 plus years, which has been doing remarkably well and has had a good run over the last few years and the last 10 years in Foster's first percentile. But then you complement that with Justin Jacobson's absolute return fund, which is more of a long short credit strategy, which has done a great job of just handling out the volatility. And there's some great stats out there that when the equity markets have negative days, this fund has traditionally usually been positive. So those are a nice complement because you can put that together, and you've got the corporate bond fund, which is really more of a strategy it's going to do better in bull markets, and the absolute return fund, which is going to do better in times of volatility. So putting those two together as the core of the portfolio has a nice smoothing out factor, and that's what we've been talking about all over, taking out those bumps in the road. And this is really something that you can use in the credit market, which has been more volatile. There's been more volatility in credit as we've seen interest rates move. But putting these together, you can get that steady stream of income with less volatility than you see in the market. So a nice Sharpe ratio, which should be good for most people and again, for most portfolios.
Yeah, that's great. I know we sort of touched on that 60-40 portfolio idea, but how do you think investors should think about the fund specifically of growth versus income within sort of a broader allocation framework? Is there reason to own each of them, or do they have different market expectations? How do you sort of look at the two?
Yeah, so I would say these are going to be something that's going to be a complement to that. So again, the 60-40, as you mentioned, is normally 60 equities, 40 bonds. But this is really starting to carve out that niche in the middle. So it's not going to say get out of your equities or fixed income, but this is really going to carve out more of an alternative section, because there are some hedging strategies. There's different risk mitigators you can use just from being long only all the time. And this is what I think a lot of portfolio theory is starting to evolve to over time, adding different asset classes, whether that's hedge funds, whether that's commodities, whether that's liquid alts, and this is really how these portfolios can fit into a model portfolio, because it's going to start to take the overall portfolio correlation down, provide what you're looking for, whether it's growth or income as the end objective, but less volatility and more focus on downside capture than other strategies out there. So this is, again, something that's going to be trying to get that Sharpe ratio going, limit some of the volatility, and trying to make it so that the end goal is going to be less volatile than it would be if you just own two asset classes that are perfectly correlated.
Yeah, no, that's great. When you are looking at these two funds, do you have the same sort of market expectations or core macro themes when you're deciding allocations within each of those?
Well, again, we do have a bit of a band between these. Within the multi-strat income fund, we generally think of the corporate bond and the absolute return fund will always range between 30 and 40% of the portfolio. And really with that negative correlation and how the funds have been managed traditionally over the last few years, what we do from a top-down point of view is if we're fairly bullish on the market and think that the next few months are going to be pretty positive, we just moved more towards the corporate bond fund because that's a fund that is more aggressive, more upside capture, and in good times will should do a lot better. Contrasting that, if we're getting a little more cautious on the market, thinking that there's going to be some volatility, whether we're going to get the summer sell-off, which seems to happen every U.S. midterm election year, that's when you can start tilt towards more of the absolute return funds. So when we're cautious, we kind of put absolute return closer to the 40%. When we're more bullish and aggressive, we move the corporate bond fund to closer to 40%. So within these bands, those funds are still always going to be number 1 and 2, but we can kind of tilt between whether which one we favor currently, depending on the macro view that the entire Pender investment team has as we sit down and discuss quite frequently our views of the market and try and figure out where we're going to add value in the next few months.
Yeah. So speaking, I guess, on your views on the market, are there any areas right now that you find particularly interesting or that you're spending more time thinking about, especially in the context of these multi-strat funds?
Well, I think the big thing that we're looking at across a number of mandates is just this whole view around real assets and commodities. Just how do they fit in the portfolios? They've had a great run over the last year plus, but we're still in a very unsettled geopolitical world. There's a lot of concerns about the U.S. dollar and the path forward on that. And there's going to probably be more volatility as we try and figure out just what the new Fed chair and what we're going to do with interest rates. So all these things are kind of pointing us towards looking more at some of these commodities and hard assets. The corporate bond fund's been adding more in the precious metal space for the last few years. Our equity mandates have been adding more of this too. So across both the growth fund and the multi-strat income fund, we have been tilting a little more towards commodities and again, thinking this is something that's going to work in an area which should be fairly volatile for the foreseeable future from geopolitics and rates. And I think we've kind of gotten used to the new normal with Trump in charge of Washington that you never know what the next day is going to be. So might as well have a little bit of downside protection and something that will work well in times of volatility.
Yeah, certainly as it's been nice from someone who used to work in mining research to have materials be topical once again after years of maybe lack of interest and lack of investment.
Yeah, we've had 10 years where no one's really looking at them for a while. And with that, there wasn't a lot of CapEx put behind this. So as we're seeing more interest in the space and more demand increase, then this is going to put more of an emphasis on bringing new projects on. And this is good for Canada. Canada's got a lot of resource exposure. And we've had the TSX outperform the S&P 500 last year. And so far off to a good start again this year. And hopefully this is something we can build off to a multi-year run for the TSX, which is a long time coming.
Yeah, absolutely. And hopefully specifically in small caps as well.
Exactly. Which really has been a forgotten sector, and small caps looking like great opportunities now from a valuation point of view. And again, just not a lot of people are there because they've been so focused on the large cap and the core of their portfolio that this is creating great opportunities in other parts of the market that have been overlooked by many.
Yeah, no, like going back to that concentration risk, specifically in Canada, I think that's overlooked quite a bit. And small cap land has been underfollowed for hopefully far too long at this point.
Absolutely. And again, that creates opportunities when there's less people looking at it.
Yeah. Are there any other themes you think investors might be underestimating looking forward that you find interesting or that you've been doing more work on?
Well, kind of tying into that comment about just things that have been overlooked, I think we're setting up for a really great period for M&A. M&A is going to be a topic which should be with us for the next foreseeable future. We've got some big IPOs coming up with SpaceX and OpenAI and Anthropic, which really are just going to start getting more corporate activity going. And when corporate activity is going and big cap companies get flush with cash, what they tend to do is buy smaller companies. So all this pickup in corporate activity should start to get more capital coming down to the small cap as a trickle down event. So I think we could be looking at another year or so of really good M&A action. So looking at investment banks, looking at some of these target companies, and that's where we've been tilting on some of the portfolios and getting set up that these valuations are starting to stand out, and cheap valuations relative to larger peers don't tend to last long, and these gaps tend to close. And usually how that happens is through corporate activity and M&A.
Yeah, and probably the leading indicator we saw from M&A was, going back to your point, in those mining companies, in those real assets. That's where we started to see the pickup of the large cap mega mining names buying these developers or junior mining cos, and that's usually a leading indicator of seeing additional activity in other sectors.
Yeah, absolutely, and hopefully this repeats itself, and that could be a good setup again.
For sure. All right, before we close off, a couple of fun questions for you. First one is, what mistakes do you think investors make when evaluating multi-strategy funds?
Well, I think the biggest thing, again, touching on the theme we kicked off with, is just thinking that if you've got more positions, that you're better protected on this. Because right now, it's not just looking at the number of names you hold, it's trying to figure out how they fit and what their correlations between the asset classes. Because if everything's doing the exact same thing, that's not helping you at all. And you're really just doubling down on the same trade. So more is not always better. Making sure that if you have two asset classes that are negatively correlated, that's better than having 100 positions that are perfectly correlated. So more is not better. Making sure that when you're looking at multi-asset funds, the underlying investments are doing what they're supposed to be and have these negative correlations attached to them.
Sounds good to me. Second one is, if we fast forward 5 years from now, what do you think investors might be misunderstanding about the current market?
Well, again, something we touched on earlier, again, it's just this risk in the current market, because buying index funds is really concentrated on certain factors. And a lot of people do just say, well, I'm not buying active managers because I just buy the passive index because the index has crushed active managers for the last 10 years. And I think the mistake can be just assuming that what happened in the last 10 years is going to work in the next 10 years, because things do tend to change when people get too concentrated on one theme. The pendulum tends to swing the other way. So I think we've gone through a period where the passive index has been the place to be, but that's not always going to be the case. And I think this concentration risk is not being talked about enough, and something that investors need to be aware of when they're looking at these index funds, that there is a lot of underlying risk in this, because you're really getting concentrated on a few themes that are might not always be there and that might not always be working.
Yeah, absolutely. Especially with the volatility we've been seeing, it seems like the tide's really starting to turn. So it's an exciting time to be in active management.
It's never boring. That's something that's been interesting.
All right, last question. I know you've answered this before, so it doesn't have to be all time, but is there something that you're currently reading or thinking about that is influencing how you either manage your portfolio or how you view markets overall that you would recommend to the listeners?
Well, there's been a few good books out there that are really starting to focus on this deglobalization theme. And I think this is a theme that's really been waking up a lot of people with the problems we've had with the U.S.-Iran war and the Strait of Hormuz. And we're starting to understand just that a lot of the shipping lanes that have been working for a while aren't going to be there forever. And this, again, plays back into the hard asset theme and commodities. And there's a lot of books being written about this in the last little bit, but these themes from investors like Larry McDonald and others are going to be around for a while. And this is something that I've been spending a lot of time reading on, because I don't think we can just go back to where we were 10 years ago. And this is going to be a theme that's going to be with us for a while and going to impact. So the more you can read on deglobalization and how we're going to have to rewire the shipping and global supply chains, the better. And this is where I think people need to spend more time focusing on.
Amazing. Well, thank you so much, Greg. Second-time guest. Thanks for coming on the podcast.
Perfect. Thanks, Laura. Glad to be back.
Yeah. So we'll continue these discussions in upcoming episodes as we sit down with portfolio managers across Pender to explore how they're thinking about markets, opportunity, and risk in real time. As always, you can follow our ongoing commentary at the Pender Pulse on Substack. Thank you for listening, and we'll see you next time.
Pender is an independent, employee-owned investment firm located in Vancouver, British Columbia. Our goal is to protect and grow wealth for our investors over time. To achieve this, we seek to understand the quality of a business or security, obtain more value than we are paying for, deploy capital in flexible mandates, and mitigate downside risk. We have a talented investment team of expert analysts, security selectors, and independent thinkers. They manage a suite of niche investment funds with active, concentrated portfolios of value-based, occasionally contrarian investments. We invest in our funds too. You can learn more at penderfund.com.